Which investment is delivering better returns in the current market? Commercial property or business ownership? I've been analysing both of these for over 40 years, and the answer might surprise you. With interest rates at current levels and commercial property prices adjusting across the country, I've been running the numbers on both investment classes, asking this exact question. By the end of this video, you'll know which investment strategy makes sense for your specific situation right now, and why the smartest investors are thinking beyond this either or question. Let's start with what's happening in the market today with the commercial property landscape. Interest rates have pushed some investors out of the market. Property prices have adjusted in some sectors since their peak. Rental yields are improving as prices soften. Quality tenants are increasingly valuable and harder to replace. Evidence of this has been the current commercial property investment sales with tenants such as franchise food outlets, service stations, childcare centres, which have long leases and are selling for 3 to 4% net. So buyers are willing to pay top prices for more secure investments. The money is out there, less people have got it. And if the property investment is right, they will pay for it. The business ownership landscape. Many business owners are preparing for retirement exits, especially the baby boomers, creating a glut of opportunities out there. Cash flow returns can be 15 to 25% for well-run businesses, but succession requires active involvement or exceptional management systems. The question isn't which is better overall. It's which suits your investment goals, risk tolerance, and timeline. Let's break down the actual commercial property investment versus business ownership returns numbers. Current property yields examples: industrial property investment 4-6% yield depending on location and tenant quality. Office property investment a bit higher, 5 to 7 yield, but vacancy risk is higher in some markets. Quality buildings have got good demand for quality tenants and selling for lower net returns. That market is a lot different to the lower market. There seems to be a higher demand for quality building from quality tenants. Retail property investment, 4 to 6%, but require more hands-on management. The capital growth prospects. Historically, commercial between 4 to 6% annually over long-term cycles. Some areas a bit less and others a lot more depending on size, location, zoning changes, etc. This varies because zoning changes means phenomenal increases in some commercial properties because of zoning changes demographics, whereas some areas haven't changed much at all, very little capital growth. The current commercial property market provides conditions, buying opportunities for strategic investors under the current conditions. Location and tenant quality are critical success factors for investment property returns. Total return expectations can be very attractive for well-selected commercial property investment properties, but requires a lot of research and work. For example, repositioning, refurbishing, development, etc. The key advantage is it's largely passive income once established, with professional property management handling day-to-day operations. Special note, I don't believe any property investment, including residential, is totally passive. All property investments require at least some level of involvement from the owners to remain successful. You keep your eye off the ball, there could be problems. Business investment returns at the moment. Current acquisition opportunities, cash flow returns. Established businesses with good systems, around 15 to 25% return on investment. Growing businesses in the right sectors, potentially higher. Service-based businesses, often 20% plus, with strong management in place. Obviously, technology these days can speed things up a lot. AI is becoming more popular. The right systems in there, I've seen examples of businesses improving marginally. For example, Temple and Webster, their share prices has gone through the roof. And when they interviewed the owners, they're saying it goes back to them implementing artificial intelligence in their business. Commercial property development and business capital growth potential. Well-run businesses can grow faster than commercial market timing. Multiple expansion when systems and processes are strong. Total rent potential, 25 to 35% annually for actively managed businesses. The trade-off, this requires business knowledge, active oversight, or exceptional management teams. The risk-reward analysis. Now let's talk about the risks and management requirements that many investors underestimate. Commercial property risks. Tenancy vacancy can eliminate income for months. Property maintenance and unexpected capital expenses. Market cycle values can decline significantly. For example, we got the COVID situation with offices. On the other hand, you've got industrial, which have been the flavour of the month because of things like COVID and more online businesses. Interest rate exposure affects serviceability and values. However, the key advantage is that it's relatively predictable and relatively passive once properly managed. Business ownership risks, management dependency. Manager who knows all the business is the main driver of the growth. You lose them, you lost a lot of your business. Market competition and economic sensitivity. Staff challenges and operational complexities. Again, that situation where there's shortage of certain skilled staff due to various factors. Again, COVID, migration, etc. Industry-specific risks and regulatory changes. Government policy changes, making it a lot difficult for a lot of businesses. However, you can actively influence outcomes through strategic decisions and operational improvements. Here's the insight most investors miss. The best risk-adjusted returns often come from combining the strategic combination approach. This is where it gets interesting and where I noticed as having dual experience in both areas. This knowledge and experience can create unique opportunities. Business plus property ownership. Many successful business owners buy both the business and the property it operates from. This creates several advantages. Collect rent from your own business for tax optimization. Control both operational income and property investment returns. Multiple exit strategies when you're ready for transition. Protection against rent increases and lease security issues. I put clients into their own properties after renting for many years, sometimes with excessive space used for improved cash flow, some of which have sold their businesses and reduced their overall investment and created a very high returning asset for retirement individually. This isn't always possible, but when the opportunity exists, the returns and control can be exceptional. Given the current commercial property market conditions, here's the opportunities that I'm seeing. Some motivated sellers are creating buying opportunities for cash purchases in property investment. Commercial property yields improving as purchase prices adjust downward. Quality industrial property investment and office property investment with secure tenants are still attracting investor interest, as I mentioned earlier. Infrastructure development, creating new commercial property development investment nodes. Business acquisition opportunities. A baby boomer business owners accelerating exit planning. Some quality businesses available at attractive business valuation methods due to owner circumstances. Many of these baby boomers haven't planned for changes in the circumstances where they must sell quickly. Opportunity to acquire established operations with proven systems. Less competition for private equity and institutional buyers in commercial property financing. The decision isn't just about investment property returns, it's about your investment timeline, risk tolerance, and involvement preference. Commercial real estate investment suits investors wanting relatively passive returns with long-term potential. On the other hand, business ownership returns suit investors willing to be actively involved for potentially higher returns and more control. Combining both investment strategies suit sophisticated investors seeking diversification and maximum control over their investments. professional integration strategy. Here's where most investment advisors can't help you because most only understand one asset class. At CST Properties, we analyze both commercial property and business investments because the most successful investors think strategically about these assets. The benefits are property investments that support your business activities, business investments that provides property opportunities, exit planning that maximizes value for both asset classes, tax optimization strategies that work across both investments. So what should I do now? First, assess your situation honestly. Investment capital and value, risk tolerance, time commitment preference, and timeline for returns. Second, consider market timing. Selective commercial property opportunities are emerging. Business opportunities exist with retiring owners. Factor interest rates into your financing decisions. Third, think strategically. Don't just evaluate individual investments. Consider how different assets might work together in your portfolio. If you're considering commercial property investment, business ownership, or strategic combinations of both, these decisions should not be made in isolation. Drop a comment. Are you leaning toward property, business ownership, or considering both approaches? Subscribe for more strategic investment analysis. The smartest investors don't choose between property and business. They choose a strategy that best serves their long-term wealth creation goals.